Welcome back, everyone. Michael here with Offshore Citizen. Now, one of the questions that sometimes comes up amongst people who are looking to get, higher interest on their deposits is, okay, first of all, where do you go? But the second is risk, right? And, like it or not, the best returns on, as what we would call interest on deposits is in crypto today. I don't mean that in, you're buying Bitcoin, it's going to go up. I mean, you buy a stable coin and you're able to earn yield on that stable coin, which can be, in some cases 20, 30%, right? Probably won't sustain at, 30%. The other day I saw one that had briefly, you had 88% on USDT. I think it was Curve or Convex, which is a very solid pool, had a brief little period recently where it was up to 50% or something like that. So you get these unusual events, but you can't really count that. You just have, because basically what's happened is you have decreasing supply and increasing demand temporarily, and it kind of balances itself out. But you're certainly doing much, much better than in banks. And frankly, depending on where you go, a lot of the banks might not be that safe, so I don't know how much extra risk you're taking on. This being said, it is definitely true that there are various different risks, and it always makes you say, okay, well, is it worth taking on that risk? Today I'm going to talk to you about a method of mitigating a lot of that risk and doing something that really makes dramatically more sense and I think is quite interesting. So we're going to dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notifications. If you'd like this video, give it a thumbs up. And if you'd like help with international structuring, international tax optimization, asset protection, forming companies, opening bank accounts, getting residencies and citizenships around the world, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below. Or send a message to our websites, offshorecitizen.net and offshorecapitalist.com. All right. So what is it that I'm referring to here? It is insurance. So here's the really interesting thing, right? If you take your money and you go and you put it in a bank in the European Union, you're typically covered for $100,000 of deposit insurance or 100,000 euros of deposit insurance, okay? Okay, it's all right, 100 grand, not a huge amount of money. What if you have $1 million? So are we saying you have 900,000 of risk? Now, I often tell people that frankly, if you're worried about deposit insurance, you're probably off to a bad start, but it is something, right? The idea that you could insure yourself up for higher amounts is appealing, right? Now, crypto happens to make this quite easy. There are two major insurance providers. One is called Nexus Mutual. One is called Insurace. They're coming out with a new product in the near future. But yeah, they've got Insurace. And I think this is incredibly compelling, okay? Because for people who are concerned about the risk, but they still want some of the upside, you can often find reasonable arbitrage. So I'm going to give you an example specifically using Insurace, okay? So Insurace has various different types of insurance that they sell, and you basically just pay a percentage calculated, daily on, what it is that you're wanting insurance on. And you can, in theory, scale that up infinitely. Now, in reality, there's limited capital pools and, they fill up and that's what happens. But you still, the point is, could insure a lot more money potentially than you could than you're going to get just from your bank, okay? So that's pretty cool. I'm going to use one specific example, but the truth is you can go to their websites and you can see that you can insure all kinds of things. And the insurance is typically one of two options in this case. One is the smart contract risk, okay? In other words, hey, listen, what if there's a hack? What if there's a scam? What if there's stuff like this, right? That's one type of insurance. The other one, for the purposes of stablecoins, is depeg insurance. What does this mean? It means that, let's say you own DAI, and the DAI drops in value from $1 per DAI, which is what it's supposed to be stable at, to 86 cents, right? They will compensate you for that. You will get paid. And interestingly, you keep your DAI, so in theory, you could get paid out, and because it's a stable coin, it could return to its peg, and you could have won out double, right? Which is pretty cool, right? Pretty cool. The way they calculate that, by the way, is over like a 10-day rolling average, and there's a certain fluctuation from the peg that it needs to be, which is fair, right? So why do I bring this up? I bring this up because one of the most interesting protocols out there that a lot of people are super interested in is one on Terra called Anchor Protocol for UST. And whenever I look at UST, so Anchor Protocol pays 20% fixed return, okay? Very high return, very high. Tough to find that anywhere else. And I look at that and I say, okay, well, the 20% sounds good, but what about the value of the UST? Does the UST value make sense? And the answer is there's a decent amount of reactivity in that price, and so it could change, right? And then maybe I don't end up ahead. Maybe I end up losing out. Doesn't sound good to me, especially if we see a major market crash, right? Price of Luna is way up. So, in that market, when everything's going up, it's easy to make things look good. When things are going down, it's a different situation. And so people had asked this previously about, how well could DAI sustain an 80% drop in the price of Ethereum? It's mostly backed now by USDC, and they're working on kind of diversifying that, et cetera. It's an interesting project. UST suffers from much the same thing. If the market drops a ton, will it maintain its peg? Well, the answer is I don't have to worry about that so much because I can purchase insurance through something like Insurace. And just kind of consider the math here. Let's say I buy DPEG insurance and it costs me 2.5%. Well, if I'm in there for 20% a year and I take out insurance at 2.5%, insurance you can go and you can see that by token and project, etc. By the way, you can insure your Coinbase account, your Binance account, all the FTX account, etc. I can see what it's going to cost me. And if I say, okay, well, if it costs me 2.5%, I'm still at 17.5%. 17.5% is pretty good. What's my risk now? Like, I do have some smart contract risk, yes. I can insure against that as well. I do have some DPEG risk, yes, but I've insured against that. And so now my risk becomes that the insurance company, that both this fails and the insurance company fails. Could this happen? Yes, this could happen. Is it particularly likely? It's a pretty low likelihood. Do you have some possible black swan events? Yes. What does this mean? I definitely wouldn't put all of your assets there. Probably wouldn't put an enormous amount there. But if you have cash sitting on the side and you want to put, let's just pick a number. Let's say 30% of your sidelined cash into some place like that while waiting for other opportunities to buy in. That sounds relatively compelling, right? Relatively compelling. I'm just pulling these numbers out randomly. Don't use these as, hey, listen, this is the number that you should work on. But if you split it up and I can insure it and the insurance is paid for by the yield and I still have a dramatically superior yield to what I would get in a bank or some other market, that's not bad, not bad. So anyway, is it something that you should do? I mean, that's totally up to you, right? I'm not going to tell you what to do or what not to do. But I think that it's interesting to note that these insurance products have come up in order to deal with some of the problems in the market and really offer some pretty potential interesting opportunities to take a lot of the risk off the table, probably diminish the risk by, it's hard to say, but probably you're taking the risk and decreasing it by 95% or something, right? The probabilities that it fails and the insurance company fails, the likelihood is dramatically lower. And so, yeah, if you combine that with some diversification, the fact that you can have multiple different insurers, you could split your staking between different insurance protocols, etc. I mean, very, very interesting, very compelling opportunity. So something to be aware of. You can go and check it out. Let me know what you think. Put it in the comments below. I would enjoy hearing from you. If you like this video, share it with your friends. Appreciate it. Give it a thumbs up. Follow me on Twitter @MichaelRosmer. And I'm going to look forward to seeing you guys on the next video.